A stock that's not moving up is Raytheon, David. Raytheon Technologies. So we got to find out what's going on. Why don't we bring in the person who runs the new Raytheon, which is the part of the old United Technologies and the old Raytheon. And I thought the quarter was very good. I want to speak to Greg Hayes, CEO. Greg, you're no stranger. Welcome back to Squawk on the Street.
Thanks, guys. Thanks, Jim.
All right. So what would have happened had you just kept United Technologies Aerospace by itself without merging it with Raytheon? What kind of discussion would be had? Would it be with Mnuchin? Would it be with Jay Powell?
Look, the aerospace businesses, the legacy Collins and Pratt businesses, they're going to have a tough year. We're going to see sales probably down 50% or so on the commercial aero side. Keep in mind, though, that both of those businesses have a pretty solid defense portfolio as well, about 30% of their businesses. So, you know, we weren't going to go bankrupt if we stood on our own. We would have probably been close to break even for the year from an earnings standpoint, but we certainly wouldn't have been looking to get a handout from the government. Yeah, it's good franchises. The business doesn't go away, but it's a tough time in commercial aerospace, as everybody knows.
Yeah, but can you talk about the defense side, which I find very interesting because defense is holding up. You pick up the Patriot missile, which has always had good sales, but frankly, the gross margins have been wanting. What can you do about that in order to be able to make it so that you take really unbelievable technology and start making more money with it?
Well, look, I think the key with the merger of Raytheon and UTX was a technology merger as well as a talent merger. We come into this merger between the two companies with about $70 billion of defense backlog. I think, we've got a good track record on the UTX side of driving cost reduction. If you think about the engine for the Joint Strike Fighter, we've built, I think we just delivered the 500th fighter. And that engine cost has come down from $20 million to about $10 million an engine, and the margins have gone up. And, we're going to bring that same discipline to all of the Raytheon businesses. We've got solid businesses. Some of them are a little bit more challenged from a margin standpoint, as you said. But again, I think as we think about the talent that we bring together, we'll have the opportunity to do more on supply chain to find savings there, as well as to bring more automation to the factories. I should point out, we've got 195,000 employees across Raytheon Technologies, and about 95,000 of those folks are working from home. But I've got another 100,000 that are still showing up to work every day to build product and to support customers. And it's been a challenge to get everybody there, but we were trying to keep them safe. We're providing PPE, and I'd just like to say thanks to all of those folks for supporting the customers. This is tough, but over the long term, we'll take cost out and we'll get margins up across the business. I think we've got, as I think we've tried to simplify the organization, the old Raytheon organization. We've got a missiles and defense business headed by Wes Kramer, and an intelligence and space business headed by Roy Azevedo. And those guys are both laser focused on cost reduction, synergies, and margin improvement. If we think about like inductions into our overhaul shops, just to give you an example, we typically get 80 to 100 engines in a month. It takes about 90 days to overhaul those, and we generate revenue as we overhaul the engines. For the month of April, that was 24 engines instead of the normal 80 to 100. So yeah, it's going to be tough. On the Collins side, repair, we repair many of the things around the world in our repair shops. Input was down about 55%. So this is going to be a tough quarter on commercial aero. I think the good news is we do see some light at the end of the tunnel as we've spoken to the airlines. They're starting to see some bookings out in the summer months and in the fall start to pick up. So we think, you'll see a recovery, but clearly Q2 is going to be very tough.
Yeah, I would imagine, and Greg, it's David, a slow recovery. I wanted to go back to your comments about sort of the factory floor, the 100,000 employees you have coming in every day, outfitting them in PPE, as you said. But what about the efficiency of their work? How do you socially distance when you're building an engine? And if you are, does that impact their ability to actually make that engine more quickly?
Yeah, David, it's a good question. So what we have been doing, and again, engines are a little bit different because they go through a production line, but usually there's one technician working on an engine that simply moves along the line. So it's not as difficult to socially distance on the engine line. More difficult in some of our facilities where we're doing mass production of overhauled turbine blades, for instance, where you've got 500 people in a factory. What we've had to do there is we stagger shifts. So we've got some people coming in first shift. We've added second, third shifts. We have weekend shifts. So we're trying to, where we can't socially distance, we're trying to stretch out the work week, if you will, to try and accommodate those people. We've got our own mask manufacturing set up in Malaysia and another factory here in the U.S. We're making about 100,000 masks a day for our folks. We've done a pretty good job of sourcing PPE, but at the end of the day, we wanted to make sure we were self-sufficient. We've got temperature scans. Every employee that comes in today is getting their temperature checked. We'll look at some testing once these antibody tests have been sorted out. We'll probably be testing employees on a regular basis for the antibodies. So it's difficult. There's additional cost. I think we mentioned on the earnings call this morning, probably about 8 to 10 cents of headwind, maybe a couple of $100 million of additional cost because of this. And that's not accounting the inefficiencies. So it's expensive. But at the end of the day, you've got to support the customer. We've got to do this work. We've got to deliver to keep the warfighter safe and to keep these airplanes flying.
Right. Which comes back to the larger picture, of course. Part of the reason, part of the promise to shareholders of this deal was significant returns of capital to those shareholders. You're putting that off a bit right now, aren't you? I mean, I believe the 18 to 20 billion you've talked about last June, you're now saying is going to take place over 4 years versus 3 years. Why?
Why? Well, because revenue passenger traffic's 95% lower than what it was last June. Look, it's pretty simple. We came into this merger with about $8.5 billion of cash on the balance sheet. We've got about $25 billion of debt. We're in a solid position from a liquidity standpoint. We took the board through this a week ago before we declared the dividend. We took the dividend to $1.90 a share. That's up significantly from the old Raytheon dividend of like 18% or so. And as we had the conversation with the board, we went through a lot of different scenarios and said, how bad can it be? And even in the worst case scenario that we put forth, we still had adequate liquidity to fund the dividend for the next 3 years. There is just so much unknown out there. I could not possibly recommend to the board to do share buybacks this year. We still see, good cash generation over the long term. But I think our commercial aero businesses for this year, where we had expected about $3 billion of positive cash flow, will essentially be break even from a cash flow standpoint. So that'll recover over the next couple of years. It'll put us in a position to do share buyback. We've also got, obviously, a lot of opportunity on the balance sheet if we want to borrow money. But in this environment, borrowing to do share buyback just doesn't make a hell of a lot of sense. So we're going to keep our powder dry, and we're going to look for opportunities. And if the stock continues to lag under intrinsic value, we'll be in the market, but it won't be this year.
So, Greg, how about China and China aerospace? How's that looking?
It's interesting, Jim. We obviously saw the same thing in China that we've seen in the U.S. That happened, of course, in January and February. Today, we've actually started to see a recovery. If you think about the global fleet, there's about 30,000 aircraft out there today. 55% of them are parked. About 40% of the parked aircraft are actually COVID related. At the beginning of the year, it was about 15% parked. If you look at China today, 3 months in, their parked fleet is only about 20%. So we have started to see a return of passengers in China itself. Of course, we have not yet seen the international traffic return, and that may be some time. But I think it's heartening as you see China as a reflection of the U.S. economy. China's the second biggest passenger market after the U.S. And I think the dynamics we see in China will probably play out here in the U.S.
Greg, it's Carl. I just had one quick question on the balance between dividends and layoffs or furloughs. Do you expect companies to have trouble optically maintaining a dividend when they're letting people go?
Carl, that is a question that we wrestled with, because obviously when you're making tough decisions on employment, having to furlough people, having to reduce people's salaries, we took a furlough across, or a 10% cut in pay for all of the corporate folks. We took and all the folks on the commercial aero side. we're going to be furloughing people as the volumes decline. At the same time, I think that we've got an obligation to our investors, many of whom are our own employees, to continue to pay a dividend. Now, we didn't take the dividend up a lot. I think it was like 1% from a UTX adjusted basis. But we thought it important that we signal the strength of the business and the strength of our liquidity in spite of these very difficult times. And what I've told employees is we're going to try and save as many jobs as possible. As we reduce spending on the commercial side, we've got a couple of thousand openings for engineers on the legacy defense side. So we're moving folks over. We're moving production from the legacy Raytheon business to some of our facilities out in Cedar Rapids. So we're going to do everything we can to maintain employment. Having said that, we know that there are going to be furloughs. There's going to be layoffs as volume goes down. But at the same time, I think it's important to signal the fact that we still believe in long-term value of the stock. And we won't buy back stock. We will support it with the dividend.
All right. So, Greg, just overall, because you're a terrific businessman that had also insight, obviously, into Otis and into climate control companies, is there any chance that you think that we may have bottomed, the country may have bottomed in the month of April?
Well, certainly from a commercial aerospace, I think you can't get much worse than down 95%. If you look at TSA traffic, I think it's down to about 150,000 people a day going through the TSA turnstiles versus about 2.3 to 2.7 million on a regular basis. So I would think that has bottomed. We've heard anecdotally that you're going to probably see some pickup here in May and June as you get to the summer season. The fact is, people can only binge on Netflix for so long. And Zoom is fun, but you can't experience the Eiffel Tower from a Zoom meeting. And you can't take your kids to Disneyland on Zoom. So people will get back. They will start flying again. They will recover. And I think April is obviously from a revenue passenger standpoint low. Now, that'll play out for us in aerospace and the aftermarket over the next probably 6 months or so, and probably then see a recovery. I think the bigger concern or the bigger issue is going to be on the OE side, where today you've got Boeing and Airbus cutting production, but frankly, nobody needs any new aircraft while you've got 55% of the world's fleet parked. And so I think, that's going to take a little bit longer to recover. You've got to take these parked aircraft, put them back in service, and then you'll start seeing demand on the OE side. I would tell you it's the same in most of our other business. I know Legacy Otis is probably as recession-resistant a business as there are, given their very strong service business. And I think Judy Marks will be on a call later today, and she'll talk about that. They made it very well through the 2009 financial crisis. Carrier, again, they saw an impact in the first quarter. Dave Gitlin will be on tomorrow to talk about that. But I think, again, the recovery will happen. But the ultimate, the bad news is the month of April. And I think everything will get better from there, assuming we don't have a big resurgence in the number of cases and hospitalizations.
All right. Well, that's excellent. And I got to tell you, Greg, I think that may be one of the reasons why we're having such a good rally over the last couple of weeks. So we just heard from Greg Hayes, who's the new CEO of Raytheon Technologies. It's always great to have you. Thank you.
Thanks, guys. Take care.